This meeting is being recorded.
Okay, good morning, everyone. Thank you for tuning in. My name is Matt Wilson, and I'm the finance officer here at DuPage Foundation. On behalf of our board, our staff, and our investment committee, I would like to welcome you all today to another webinar with our partners over at Northern Trust. Before we start, just a few housekeeping items. Today's webinar is being recorded and will be made available to all participants after today's program concludes. If you have any questions, please use the Q&A feature. We will address those questions at the end of the hour. And if you have any questions specific to your fund, please contact me at the email in the chat right now. Joining me today is David Weiss. He's the VP of Finance here at DuPage Foundation. And then joining us from Northern Trust is Marty Morris. He's the Senior Vice President and Portfolio Manager with the Foundation and Institutional Advisors Group. And then also joining us is Wouter Sturkenboom. I hope I'm saying that correctly. He is the Chief Investment Strategist of Europe, the Middle East, Africa, and Asia Pacific. So with that, I'll hand it over to you guys and feel free to take it away.
Great, thanks, Matt. I'll share my screen quickly so everybody can follow along. Sorry, gotta scroll back to the top. Gotta love technology. Hold on one second. All right, there we go. Got everything all set up. Thanks, Matt. So as Matt mentioned, I'm Marty Morris from Northern Trust, Senior Portfolio Manager working with the DuPage Foundation on their investment portfolio. Real quickly, today's agenda, I'll give a quick introduction of Northern Trust and who we are. I'll introduce Wouter, our special guest today, and then at the close of the meeting, I'll give a quick overview of the portfolio, looking at the asset allocation and performance that we've generated in 2022 and in the fourth quarter. So for those not familiar with Northern Trust or new to our call, Northern Trust is one of the nation's largest financial services firms. We have a global reputation for investment management and custody services, and it's been underpinned for over 130 years by our strong culture of service, integrity, and expertise. That expertise extends to the nonprofit sector. So where our foundation institutional advisory team was created back in 2006 to service nonprofits, other tax-exempt organizations exclusively. We're a national practice, consultative, dedicated to serving the specialized investment needs of foundations, endowments, ERISA, other nonprofits in the areas of investment management, asset allocation, manager selection, custody, performance reporting. We have almost 400 clients globally with a combined assets under management of nearly $15 billion. The next page highlights some of the value-add services that we offer. Includes investment management, account administration, specialized nonprofit banking and credit, and philanthropic services like donor-advised funds and planned giving. So to quickly summarize, why do clients work with us? It's really to gain access to our sophisticated investment solutions, our strategic insights, and our world-class resources. And joining me today is one of those world-class resources. As Matt mentioned, we're joined by Wouter Sturkenboom. He is one of Northern Trust's chief investment strategists outside the US, so primarily Europe, Middle East, Africa, and Asia Pacific. Wouter is a member of Northern's interest rate strategy committees and our investment policy committee. So he's a valuable resource for our foundation's institutional advisory team internally at Northern Trust. And I'm happy to share Wouter with our audience today. So Wouter, I will stop sharing and pass it over to you.
Thank you, Marty, for those kind words and the introduction. Let me see if I can now share my screen. So, so you can see the presentation from my end, but I'm having some issues with I was trying to fix this, but.
If you want me to share, I can do that, Wouter.
Yeah, maybe that would be better, Marty, because
Yeah.
I'm suffering from the same issues with you as with the Zoom setup. Hopefully everyone can hear me all right. I hope I'm not echoing because I'm doing this from my laptop as opposed to the normal setup. So again, apologies tech-wise. It's been a bit of a struggle today. Thanks again for making the time to see us today. And what I'll try to do is give you a bit of a sense of how we're looking at the world from a asset allocation perspective. Like Marty was saying, I'm a member of various committees within Northern Trust that sets the asset allocation. So I'm a member of the interest rate strategy group. I'm a member of the tactical asset allocation group. And I actually co-chair that with my counterpart in the US, Chris Shipley. And I'm a member of the CMA working group, which sets the strategic asset allocation. So all of that is available to us for discussion today. I think what we're going to try to do is get through some of my introductory remarks and then open it up for Q&A. Because I'm based in Europe, I'm actually based in Amsterdam, and I cover both Europe and Asia-Pac. Any more detailed questions on the outlook for Europe or the ECB or the Bank of England, or perhaps China's reopening could be of interest to you. I'm here. Fire away would be my advice. All right. When we look at the world in 2023, so that's from an annual outlook perspective, it's important to take one step back and think about how are the current events sort of looking through the lens of our strategic asset allocation. So Marty, if we go to the next slide, I want to quickly address the core themes that we are focused on from a strategic perspective. So this is a 5 to 10 year investment horizon for the future. We use these themes continuously in our asset allocation process to filter incoming information. That's really important to us because if you don't use those filters, it's really easy to get whipsawed by the markets. And we've seen the volatility, the strong start to the year, and now over the last two to 3 weeks, a bit of a step back in markets. We've seen how volatile things can be and how quickly market narratives can change. If you don't want to get caught up in that news flow, it's important to use a filter like our strategic themes. And of course, you can use your own, but these are the ones that we've been using. And I quickly want to zoom in on a couple of them. One is that from a growth perspective, we still believe that we are in an economic slowdown. Clearly, the data has come in better, both from Europe as well as the US, and of course, the reopening in China will also improve the outlook there. But that doesn't mean that we're not still in an economic slowdown. It's just a lot less bad than we were fearing, and the recession risk has really dissipated, both in Europe and in the US. Still, slow growth as a core theme is still very much in play and will have an impact, we think, on things like corporate profitability being a headwind to that outlook. The inflation outlook is still one where we feel that the inflation recalibration is real, but of course we're in that transition period where we're going through an inflation adjustment from very high headline levels to much more modest headline levels, and the uncertainty around that path is of course occupying our minds very, very much. However, we think from a big picture perspective, if you look at the turnaround that we've seen in the inflation dynamics, and if you look at the inflation expectations as priced in both swaps and break-even rates, it still looks to us that we're on course for the recalibration that we're expecting strategically, which means inflation will come down, but will stabilize at a level, for instance, for the US at roughly 2.5%, which is above the level that we had pre-pandemic, which was slightly below 2%. So that's the recalibration. It's moving forward. We had a really strong run of data basically since June last year, continuously pushing inflation down more than expected. But the last inflation print, of course, was a little bit of a disappointment in that regard, on the upper end of our expectations curve, and the revisions to the benchmark were also a little worse than expected. So the inflation story has, over the last couple of weeks, picked up a little bit more volatility, but still we think we're on trend. We just got to monitor the trend very, very closely. And finally, the monetary drought theme, as well as the regional rebuilding blocks theme, is still very much alive as well. So central banks are tightening, are expected to continue to tighten, and are clearly focused on inflation as their primary concern, which means we're going through a period where we had a monetary flood to a monetary drought, still very much in play. And all the sort of pronouncements from central banks need to be really filtered through that lens, because they are quite restricted in the way they can talk about monetary policy, knowing that the headline rate is still so elevated. So don't focus too much on month-on-month pronunciations from central banks. Focus more on the trend that they're focused on inflation, they're going to tighten, and whether they end up in the case of the US at 5 or 5.25, or maybe even 5.5, which we don't think, but that could happen, of course, doesn't really matter as long as they basically stay the course on the inflation side and pause when they feel they've done enough to bring the rate down sustainably. Finally, the regional rebuilding blocks theme, important because we're watching the China angle very, very closely. We've seen that theme play out. We've seen restrictions on tech exports ramp up. And now, of course, the angle towards the Russian developments is really important. Because if China decides to side firmly with Russia and start supplying arms and to support its invasion of Ukraine, that would be a very, very serious geopolitical event. Interestingly, over the last couple of days, the meetings that have taken place between Russian officials and Chinese officials are, at least by some geopolitical experts, explained that China is actually backing off from that trajectory. But others don't think so. So it's a very live debate, but we do think that it's an interesting take because basically China doesn't want to spook the West any more than it already has. And it doesn't like the fact that the US has been successful in, for instance, corralling the Netherlands and Japan on the semiconductor side into the US's corner and restricting those exports. So that's an interesting angle. The theme is still very much in play, but whether or not China will sort of accelerate that theme, that's still very much open question. If we go to the next slide, Morty, the way we've translated those themes and the general trends in the return expectations are still very much in play as well. I just want to focus here on the general conclusions, not the numbers themselves. They're already a little bit out of date after all. But the general conclusion is still that you're looking at much better returns in government bond space. Obviously, rates have come up a lot. Equity returns are still better than they were prior to the sell-off, but not quite as high as you might expect because some of the headwinds from monetary drought with higher interest rates basically weighing on valuation multiples, and of course the deglobalization trend as well weighing on profit margins. Those two things have kept our return expectations on the equity side in check. Still better, but not maybe as good as you would expect after a 20% sell-off. And then finally, on private assets, that's still where we see the most attractive returns, even if we account for some of the dry powder that is available in that sector still today, and the valuation backdrop that brings. We still think there's very attractive returns to be had there. Now, I want to basically mention one thing before I go on to the 2023 outlook, which is the question we keep getting from clients is, how can we have gone through an interest rate cycle this steep, this quickly, without major things breaking? In fact, the things that have broken, from SPACs, valuations to crypto, to the crypto world, none of it has turned into like a massive systemic risk. None of it has really broken things in the financial markets. Financial markets have sold off, but nothing has really broken. How can that be, given the fact that we are going through an interest rate hike campaign that is more severe than we've seen in 40 years? And clearly the debt dynamics in the current world are very different from the debt dynamics that we had 40 years ago. And the truth of the matter is, I think there's two explanations. One is financial regulation actually did a good job. And we should be a little bit more appreciative of that, because we tend to be critical of regulation, but sometimes it really does what it needs to do. And in this particular case, I think we're seeing that because leverage levels have generally been quite low. And it takes leverage for things to blow up. We saw that in the UK in the LDI crisis, when the government bond yields spiked higher after that mistaken budget announcement from Prime Minister Truss. We saw that the levered players in LDI space, that's liability-driven investment space, they got taken out. There was a systemic risk there. That was, of course, a concentrated one-off event, but we haven't seen that in other parts of the world, and that's because leverage just hasn't been really a big factor this time around. And we think that's because regulation has done its job. The second reason is actually a little bit more interesting, I think, and I wanted to mention it up front because we have to keep that in mind as we go through the annual outlook for 2023. And that is that despite the fact that we had this massive increase in interest rates and the associated mark-to-market losses that come from those rising interest rate environment, we haven't seen players being taken out. Why is that? Well, one reason is probably because we've had central banks go on this massive quantitative easing campaign over the last couple of years, which means that they're actually holding trillions of dollars, both in Europe and in the US and in Japan, of government bonds on their books, which means that the mark-to-market losses occurring in that space have actually to some extent been happening in a balance sheet environment that's basically bulletproof. And the estimates are quite large, just so you know. So 2.5 trillion of losses in bonds are probably currently sitting on central bank balance sheets where they simply don't have any systemic risk associated with them. It will mean less dividend payments from central banks to governments, but it doesn't mean things are going bust. So that's an important thing to remember, that in terms of this environment being a little unusual and less volatility emanating from this big campaign of rising interest rates, that's probably a big part of that. Okay, going to the 2023 outlook, I think the first step we have to take on the next slide still is to look back to 2022. 2022 is a year we'd like to forget. It was a tough year. Both bonds and equities sold off. Correlations went higher because inflation was the dominant risk factor that markets were pricing off of. That's the story of 2022. And we'd like to leave that behind. But the fact of the matter is that when we look at 2023, the factors driving that environment are still very much with us, meaning we still have an energy price shock that we have to contend with. It's a lot less severe than we feared, but it's still with us. We still have geopolitical uncertainty associated with the invasion. Again, it's calmed down and the market impact is much less severe again, but that could change and there's still a risk premium that we have to account for. And finally, of course, the interest rate environment, the rising rates and the headwind to economic growth that brings is also still very much with us. And that really gave us sort of the framework for thinking about 2023, which is, on the one hand, the structural forces that are acting as a headwind to economic growth are still with us, and there's still going to be a headwind to economic growth in 2023, as well as everything that entails in terms of corporate profitability. So the fundamental backdrop is still one where there's a headwind that dominates, even though China is reopening, and that's going to be a little bit of a relief for global growth. From a Western perspective, we still think that the dominant force is still energy headwind, interest rate headwind, slowing economic growth. At the same time, because some of the factors that drove the uncertainty part of the equation in 2022, how far were central banks going to go, how high was inflation going to go, now that we get a sense of how far central bankers are planning to go, and we get a sense that inflation has peaked, we see the uncertainty around those factors dissipating. And that uncertainty is really important because that drives sentiment. So even though we still have a fundamental headwind to contend with, on the sentiment side, there's actually scope for an improvement if markets get a sense that this is where we're going to land, this is where we're going to pause, and that's the inflation trajectory going forward. And January, of course, was a hugely important month in that respect because we saw the sentiment improvement be the most dominant factor in driving performance. And then, of course, over the last couple of weeks, we saw some of that roll over because the uncertainty around inflation and the central bank response function actually picked up again. So fundamental headwinds, sentiment upside potential, but not guaranteed because it depends on how those trends in inflation and monetary policy evolve. So going to the next slide. Yeah, there we go. The way we do tactical asset allocation is continuously scoring these trends, scoring the way we look at growth and inflation, and basically making sure that we have a good sense of how growth is evolving relative to expectations, how inflation is evolving relative to expectations, and going region by region through those building blocks. And what you can see here is that relative to expectations, we think that we are actually looking at a bit better of an economic environment than we did. That's of course been a factor of the fact that the energy price headwind has dissipated to a large extent, and that the interest rate headwind has actually not been as material as we feared as well. Again, that's probably because some of the losses have been stuck on central bank balance sheets, and there has been and leverage has been much lower than in previous interest rate hike cycles. So from a growth perspective, things are looking a little bit better relative to expectations, but that is best explained as less bad. And I want to make sure that that's very clearly understood, because less bad is not good, right? Europe avoiding a recession does not mean European growth is going to be gangbusters. It just means that some of the downside risk has been eliminated because energy prices have come down and because we're working through the interest rate cycle in a more benign manner than we anticipated, plus the fact that China is going from a headwind to global growth to a tailwind to global growth. Still positive from a direction of change perspective, but you still have to contend with the slowdown in corporate profits nonetheless. On the inflation side, the balance of risk is still very fine. If you look at the US, we do think that the risk, so the inflation really has quite big fat tails right at the moment. Inflation expectations are pretty firmly anchored, 2.5% to 3%. But we all know that given all the uncertainties around the inflationary drivers in the US, it's housing and as well the strength in the labor market and wage growth. In Europe, it's energy and food prices, as well as some strength in the labor market as well. There are still uncertainties there, which means that the tails of the inflation outcome are very fat. We have to acknowledge that. In the US, we actually think that the risk of inflation coming in a bit higher than expectations, it dominates, which is why we have that overscore. Whereas in Europe, we actually think, and in China as well, we actually think the downside risk dominates, meaning that we're going to undershoot on the inflationary side, given what's happening in energy prices. So that's how we're reading that space. Now, if we go to the next slide, you can see exactly what I mean by the less bad outlook. So this is the PMI survey. We actually had an update this week, which showed the same picture, which is manufacturing PMIs are still below 50. Economic growth is still slowing down, but the numbers are improving, which means the slowdown is not as severe as initially thought, and the outlook is not as bad as we initially thought. So this is what I mean by saying growth is still slowing, but the expectation is for less of a slowdown than previously anticipated. That doesn't mean, however, if we go to the next slide, that we still shouldn't contend with the fact that corporate profits are softening. So again, if you're an investor and you're looking at the equity market, this is still a reality. We have seen those earnings expectations being ratcheted down. We even had negative earnings growth in the US for the first time in a long time. That is because these headwinds are real. So revenues are under pressure, and profit margins, also very importantly, are under pressure as well. Just a quick point on the profit margin side, by the way. So a lot of focus is being put on what I call the volume indicators of the labor market, unemployment and non-farm payrolls. And a lot of attention is also being put on the value side of the labor market, which is wage growth. But of course, we should always recognize that that's still only one component of the cost structure that companies face, and it's still only one component of the output cost that we have to face. Meaning, if you have a tight labor market, you could expect wage growth, which has been declining, to pick up again later this year. And that would, of course, be a cost increase to companies. But unless they are fully pricing that through, meaning they keep their profit margins constant, the inflationary impact is an open question. What we've been seeing over the last couple of months is that companies, to protect their revenues, have actually been lowering their profit margins. And that means that the net inflationary impulse from the labor market to the end consumer has actually been less pronounced than what those strong labor market numbers in and of themselves would suggest. Again, we need to look at all of these things in conjunction to get that inflationary picture correct. All right, going to the next slide, on the inflation expectations front, again, just a quick reminder that we are priced for inflation expectations that are quite benign. We have seen a bit of an increase over the last 2 weeks. So we're now, I think the US is now sitting at 2.8, 2.9, and Europe is, I think, at 2.6. It's been increasing a little bit because of the strength of the economic numbers over the last couple of weeks, but still quite a benign outcome. From a monetary policy perspective, which is where I'm going next, that does mean that from a central banker perspective, this part of the equation at least is looking pretty good. Their credibility as measured by inflation expectations still looks pretty good, which I think is important because we are seeing a little bit of what I call the Rambo Volcker mood in central banking, meaning every central banker wants to be remembered as Volcker, wants to be a tough guy, wants to be strong on inflation, wants to be a Rambo in terms of how he's perceived by both markets and by history. But the truth of the matter is that I think the Volcker line of thinking was very successful in the environment of the 70s, which was very different in terms of labor market dynamics, as well as financial market and debt dynamics. The environment we've been in over the last 10 years, I think, should be much more focused on the success of Bernanke in working through the financial crisis and Draghi in working through the Eurozone debt crisis. Those were the real successful central bankers in the current age. And I think they've been underappreciated. And I worry a little bit about if that stays this way, particularly in the ECB, we've got a few Rambos. I worry a little bit about the risk of over-tightening, where they're not simply appreciating how much success they've had in keeping inflation expectations well anchored, and they're overzealous in bringing inflation down, meaning they're almost looking to incur economic pain to get where they want to go, even though it's actually not quite necessary. So there's a little risk of over-tightening, and again, I think Powell has done a good job in going from 75 to 50 to 25, but in the ECB, there's a few more voices that are spoiling for a fight, so to say. And that's certainly a risk factor that we're keeping in the back of our minds. Going to the next slide, you can see how we're scoring those central bank activities. So despite what I just told you around my worries around the ECB, I still think that there are more dovish voices that are just being a lot less silent, a lot more silent than they should be, that are actually going to calm things down, which means that we still have a less restrictive score, but that score is on watch. Because when we have our meeting in March, which by the way will be characterized by a revision in the macroeconomic projections, it will be very important to see whether or not the ECB lowers its inflation expectations and actually pivots, like Powell has done, to a 25 basis point increase rhythm. They're going to do 50 in March, but then after that, they should go to 25. And if they don't, if they stay hawkish, that score is going to flip to more restrictive, and we're going to be much more cautious because the risk of over-tightening will have gone up. For the US, we're at more restrictive, but actually we're quite close to consensus. And for China, of course, China's in support mode, we're in less restrictive territory. Going to the next slide. And the fiscal side is pretty much where it is in terms of the dynamics. The next slide, I've already talked to this slide, but I just wanted to bring it up so you have a good sense of just how unique the current monetary policy campaign really is. And again, if you see a slide like this, where you see basically a monetary policy mix across multiple central banks in a 12-month period, hiking rates more than they've done over the last 40 years, a little bit of caution, a little bit of humility is really necessary, because we simply cannot think that we believe or know what the impact of this interest rate cycle in the real economy really is going to be. This is just unprecedented, at least from our investment time horizon. That alone is a good reason, I think, to urge central bankers to basically go 25 basis points a meeting and see how it goes, because we don't know what the lagged effects of all those interest rate hikes that we've already seen will be. Unfortunately, like I said, I think we're seeing that behavior from the Fed, but not yet from the ECB. So we have to wait and see. So that brings me to our base cases and our risk cases and our positioning before I'll open it up to questions. So from a base case perspective, fundamental headwinds means profits are softening, but like I said, because the economic data has been a little bit better, we do think that sentiment is firming. That being said, sentiment is very fickle. We had a good January. February is more difficult. So it comes and goes, and it really depends on the inflationary side coming through. The disinflation that we experienced was very strong, almost too good to be true, and some of that has indeed been revised away, especially again in the US. But we still think we're on track because the base level effects are still very large, meaning large numbers are falling out, and we're still seeing very benign developments in both energy as well as industrial metals, which, by the way, brings me to an important point, which is that the focus of China and the reopening was going to lead to this huge surge in energy and metal prices, hasn't happened. Again, goes to show that not everything is as you think it will be, because the dynamics are very, very important. And in this case, the dynamics are that China is actually not looking to stimulate its economy old school through infrastructure and real estate investment, but is instead looking to stimulate through the consumer channel, through services, more domestically oriented, meaning that the incremental demand will be higher for metals and energy, but not as much as people were fearing. Also, of course, important has been that the sanctions regime put on Russia has been largely successful. Oil is still flowing, but at a much lower price. So the revenue that Russia is getting is much lower. That was exactly the goal. And that has been, to a fairly good extent, has been successful. Inflation is, of course, a major watch point, and the labor market is going to be very important, as well as the productivity and the profit margin perspective. So we're really looking at those three components in detail to get to an outcome. So looking at the portfolio on the next slide, again, because it's such a close balance between the fundamentals and sentiment, we're not taking huge risk positions right here. We're positioned slightly overweight risk, but we're taking that risk through high yield bonds, not through equity markets. We still worry about the long-term prospects of China through its dependence on real estate, and of course the government's role in that economy is too large for comfort. We just had another private banker disappear in China. That doesn't help from a foreign investment perspective, to say the least. So we continue to be worried there. That's why we have an underweight, and we prefer to play the improvement in global growth of the reopening through our natural resources overweight. We're underweight duration. That is going to come under review in the next couple of months. We hit 3.5% on the US 10-year, which was the bottom of our range. We're now getting pretty close to the top of our range at 4%. So we're happy to be underweight duration right now, but that might change if we feel that the market has overreacted a little bit to the strong growth and strong growth numbers and the slightly higher inflation numbers. Risk cases on the final slide, and then I'm going to stop because I feel like I'm already close to being over time. Clearly, if wages do pick up again, so if the labor market stays tight in volume terms, and that pushes employers to push up wages in the second half of the year, not our base case, a risk case, then of course you have to worry about the feedback loop back to higher inflation and of course the central bank response function. I think in terms of a normal economic scenario that plays out badly for markets, the scenario would be centered around a Fed that restarts its hiking cycle after pausing. That would certainly be bad news for financial markets in a more conventional economic scenario. So that's something that we're watching as a risk case. Of course, the debt ceiling in the US is also a risk case because we all know that the US is the supreme risk-free asset provider. And if that comes under scrutiny, that could have lots of implications. Frankly, a proper default is almost unheard of and unfathomable in terms of its impacts. But that's not our risk case. Our risk case is just political volatility causing market volatility. Our hurdle for actively trading that event is really high. Instead, what we prefer to do is raise a little bit of cash, as you saw on the previous slide, and have a bit of dry powder available. Should there be volatility, we have a bit of dry powder available to step in and use that volatility to hopefully make attractive purchases. To actively trade out of, for instance, risk assets in anticipation of that volatility, that's really difficult for us to do because it's such a, it's political and it's so difficult to call. So we have a really high hurdle for that. We're more reactive than proactive because we just want to be humble in our ability to predict political outcomes such as this. In the end, we think it will work its way, through the system, meaning I don't think anybody's really going to push for a default, but we all know that the politics are, let's put it mildly, are difficult. So volatility is certainly something that we're going to be watching, and that's why it is a risk case for us. All right, I think I may have already overrun a couple of minutes, so I'm going to stop there and open it up for questions.
Okay, so the first one for you, what are some of the reasons why PE is expected to outperform all other risk assets over the next 5 years? If you could just touch on that.
Yeah. Of course. Good question. So the way we model our PE expectation is we look at the historical returns that have been achieved. So we look at the benchmark returns, we look at how much alpha PE has been able to generate, and then we go and look ahead. So that's the historical part of our analysis, and then we go and look ahead as to what we think the forward-looking environment will afford us. So that 9.6% return expectation, just so you know, and by the way, we are willing always to provide supporting materials to give more insight, derives from a 6.1% global equity return forecast plus 3.5% premium, which historically we have had 5% alpha generation. So we've lowered that to 3.5%. And of course, we know that through fulfillment, we've actually been able to do even better than that. But that's fulfillment. That's not what we do. We do the asset allocation part. So we don't take that in. But we do, of course, talk to our private guys, ask them about what are the trends in the industry? How does the higher interest rate environment hit the outlook for PE? Obviously lowers their return because it lowers their leverage and it makes it more costly to put leverage on. And then the second part, that was one reason why we lowered our expected premium. And then the other part was, like I said, the dry powder that was still available. That's actually been coming down of late, especially in venture, but still a factor in PE. Lots of dry powder means on average bid prices are being bid up, or buy price, the price at which they're buying companies has been going up, which of course lowers your prospective return. So that's another reason why we lowered that alpha premium. But that's those two components, and that's how the return has been constructed.
Okay, and then just one more here. What balance should be maintained between stocks and bonds for the average investor?
Sorry, what bands you?
What balance? 60-40, 75-25? What is Northern CSE as a sort of ideal weight allocation?
Yeah, well, that's certainly something that we would tailor to our clients. So from a model portfolio perspective, we actually have a whole series of model portfolios that go from 90% equities to 10% equities, I believe. So it's really all about what are your goals, what is the risk appetite that the client has, and how can we manage that. The bigger question that we have seen, of course, come up is the 60-40 portfolio, given the correlation change that we saw in 2022, still any sort of reasonable guide for us going forward, or should we really adjust our expectations going forward much more for a much longer time period? And our answer to that question is, well, actually, we do believe that there is still value in taking a 60-40 starting point, still thinking about correlations from a long-term perspective, not just from a 2022 perspective, and taking sort of the lessons that your strategic portfolio can bring to you in a well-diversified sense, taking those lessons on board. So we are still sending that message, and it's because we still believe that inflation, although recalibrating higher, is going to come down from current very high levels to much more reasonable levels. So if we didn't believe that, if we believe that inflation was going to be structurally, let's say 4 to 6% in that range, then of course you worry a lot more about those correlations on a longer term basis. But that's not our view. We do believe that we've peaked. We do believe that inflation will come down further this year and then hit target next year. And that means that correlation should also shift back to negative territory between equities and bonds, that is.
Okay, awesome. We do have a few more questions in here, but they do seem more tailored toward our portfolio and for Marty. So I'm going to hold on to those until the very end. But thanks for joining us, Wouter. Great presentation.
Thank you.
Can I lob a question? Thank you
for having me. If there's any follow-up questions or anything.
Wouter, can I lob a question in last minute here? You talked about China reopening. Is there places in the globe or sectors we should be thinking about that will benefit the most from China's reopening?
Yeah, I do believe that despite the fact that the reopening is going to be less focused on investments in real estate and infrastructure, I do believe that the metals and mining sector is a beneficiary of that reopening, because the incremental demand should still come through, and current inventory levels of those metals are quite low. So I do still believe that metals and mining has potential there, but it's more of a valuation play than a massive increase in price play. So there's a balancing act there that you need to keep in mind. Otherwise, the truth of the matter is that if you really believe that this was going to be a great success story, it would be Chinese equities, because they are positioned in the areas that the government is targeting in terms of consumer spending and services. And like I said, because we have those medium-term concerns, we're just not willing to take that short-term risk at the moment. So we're looking through that potential to the more medium-term risks associated with that trade and deciding not to participate. But that, if you feel differently, then of course that could be an area to look to.
Great, very good, thank you.
All right. Well, sorry about the bad camera for my laptop and everything, but thank you for having me. And if there's any follow-up questions, then I'll be happy to address those through email when they come through. Thank you.
Thank you.
Matt, I'm going to probably jump to kind of looking at the portfolio, if that's okay.
Yep, that'd be great.
All right. Yeah, I will reshare my screen. Yeah, I thought I'd just spend real quickly kind of look at kind of our different asset class views. And anytime we turn the page to a new year, I think it'd be helpful for people on the call today, just kind of put in perspective the way we think about different asset classes. Wouter gave our long-term view for these different asset classes. But if you kind of dialed back in a little bit of a shorter term period, these are our next 12-month outlooks for different asset classes. Wouter mentioned our forecast range for the 10-year yield, which is in the green box on the left, ranging from 3.5 to 4. You roll that where we are with valuations and yields for investment grade credit, where we expect kind of low single digits. Same for inflation-linked bonds, and we still see outsized opportunities in the high yield space. As we sit here today, Wouter mentioned our favoring credit over term, which gives us an underweight investment grade and overweight in high yield fixed income. On the equity side, again, the green box on the left kind of gives our outlook for next 12 months earnings for the S&P 500. Very low single-digit growth for the U.S. Actually slightly negative at 3.6% growth, negative 3.6% growth. Roll that in to our outlook for equities across the globe. So sitting against, this is after January, we pulled forward a lot of our positive performance we had for equities as an asset class at the beginning of the year. The very good January pulled forward a lot of those returns. So sitting here today in February, our outlook for the next 12 months for equities is, again, low single digits, about just under 3%. And outside the US, slightly better, kind of given a better valuation setup for equities outside the US at 6% and 5.5% for developed and emerging markets. From a real asset perspective, Wouter mentioned this was one of the few places last year where we offset some of the negative returns we had across the portfolio. So global natural resources, a very good performer last year. We still expect there to be positive high single-digit returns in the natural resources space. And then on real estate and infrastructure, real estate struggled last year, obviously with the quick jump in interest rates that we saw with short-term rates going up over 2% in very short order. Real estate underperformed, but the graph on the top right, I think, does a really good job of laying out the case for real estate today versus what we saw back in the great financial crisis in 2008. Back then, leverage was very high for real estate companies, and they had not termed out their debt, so a lot of that debt came due, and they didn't have the resources to pay it. But not the story today. Companies in the real estate side have termed out their debt into the future to somewhere between 6 and 7 years on average, and debt levels are at a very low level compared to where they were back in 2008. So that's why we continue to think that real estate will be a valuable portion of our client portfolios. Wouter gave the backdrop for our positioning. We spell it out really clearly on this page, kind of summarize it with plus, minus, and equal signs at the different asset class and sub-asset class level. We do have a small overweight in cash, but we think that provides some optionality. And for the first time in a long time, we're actually getting a return on our cash portion of our portfolio. So as the Fed has raised rates, we continue to get higher yields on our money market funds. We're over 4% today, on the way to 5%. So in very short order, we will be getting somewhere around 5% returns on our cash as we try to find the best place to put that, whether it's the risk control portion of a portfolio or risk assets portion of the portfolio. We are underweight investment grade and overweight high yield, it's been mentioned. And then from an equity perspective, we still maintain an underweight posture to equities, primarily coming from emerging markets. Wouter mentioned the reopening of China. We did dial back some of our underweight in emerging markets after China reopened, understanding that there's going to be some ripples that come from that and a positive effect. So we did not want to be as much underweight EM as we were prior to that. So it still remain underweight EM given the risk that Wouter talked about, but equities in the US and developed markets, we are equal weight. So turning the page to the current portfolio asset allocations, this is a snapshot as of earlier this month. So as advertised, DuPage Foundation's pool of assets that we manage are slightly underweight equities as an asset class, again, primarily coming from our underweight to emerging markets. From the fixed income space, we do have a small underweight to investment grade fixed income and a small overweight to high yield fixed income, again, with their favoring credit from a fixed income perspective versus term or investment grade. On the alternative side, we do have a very well diversified portfolio of alternative assets for the DuPage Foundation pool. So we include both global real estate infrastructure, commodities, where we have added a small overweight given the rebound in China's reopening. Do have a position in hedge funds, which in 2022 did a great job of what they were supposed to, hedge the downside protection in the portfolio. And private equity is a very large and growing portion of the pool of assets that we manage. And that there again provided a good hedge for returns in 2022. So turning the page to performance, and I know some of these numbers get a little bit small, so I will try to zoom this in if I can. So this is our performance through the end of 2022. I would turn your attention to the middle of the page where we have the year-to-date returns for 2022. I'll just kind of go asset class by asset class to give everyone a feel for what happened last year and in the fourth quarter. For the year, equities finished down somewhere around 18%, 18.23%. Fixed income finished down 12%. Alternatives, that again, including our well-diversified real asset portfolio of commodities, real estate, hedge fund, and private equity, finished up for the year at 4.78%, driven by, again, the outperformance in commodities and the returns on private equity, the lagged returns on private equity remaining positive for the year. So all in, net of fees, performance for the year finished down just over 11% at 11.19%. We do have a custom benchmark that we've set up to track our performance. That custom benchmark for the year finished down closer to 12%. So in a down year for performance, we were able to add some value to our portfolio. It's sometimes kind of a small consolation to add value, but in a down market, having that well-diversified portfolio and using some of the portfolio construction techniques that we did, we were able to limit the downside of returns in 2022. Important to put that in perspective versus the classic 60-40 portfolio. We had the question come in about, what is the best asset allocation? So just to give some perspective, 60% global equities, 40% global fixed income portfolio last year would have finished down somewhere around 16%. So again, the diversification moves that we made in DuPage Foundation pool and the portfolio construction techniques we used kind of limited that downside to 11% versus the naive benchmark being down 16%. Turn the page to the fund level. This kind of spells out some of the performance we got across our funds. I guess I would zero in on some of the active managers we have on the equity side. So we do have an active manager, Coho Partners, which is primarily a value manager from a style perspective on the equity side in the US, and Poland Capital, which is a growth manager. I saw very divergent returns from both of those managers in 2022. So Poland, historically very successful manager in the growth style space, struggled last year in 2022. Coho Partners had a very good year versus their benchmark and versus kind of the core equity benchmark. So having that combined value with Coho and growth in Poland in the portfolio in 2022 provided some benefits, again, from a portfolio construction perspective. On the fixed income side, I would point out the returns that we had, down almost 12% as an asset class versus 13% for the Bloomberg Ag or kind of the broad fixed income benchmark. In a rising rate environment like we saw in 2022, having less sensitivity to interest rates or a lower duration was beneficial. So that played out in the returns in the portfolio, where having that less sensitivity to interest rates helped out returns for last year. Going back up to the top, kind of looking at the fourth quarter returns. The fourth quarter was a very good quarter for risk assets. So the equity portion of the portfolio finished up over 10% in the fourth quarter at 10.4%. U.S. large cap finished up 7.5%. Turning the page, international developed finished up 17.4%, and emerging markets were up 10% in the fourth quarter. So very good risk on environment in the fourth quarter. We've seen that continue in 2023. Very good January. Portfolio's returns were up almost 5% in the month of January, all in. Talk a little bit about private equity. We do have about a 14% position in the portfolio in private equity. It's something we're actively managing and growing that portion of the portfolio. As I've probably mentioned before, the private equity returns get reported on a lag basis. So what we're seeing here are basically the marks to markets in the private equity portion of the portfolio going back to the third quarter of 2022. As we get into March and April of this year, we'll get the final marks for 2022. But as I mentioned, private equity gets reported on a lag. Obviously, we saw the liquid markets on the equity side, underperform in 2022. Private equity reporting kind of on a delayed basis, have not seen that effect yet. So that's something we're going to be watching as we get the fourth quarter marks to see how much of a linkage we get between the illiquid portion of the portfolio in private equity terms versus what we saw in the liquid portion of the portfolio in 2022. So I guess I'll pause there. So Matt, I think you mentioned there might have been a couple of questions, so I want to leave a little bit of time for that. I think you're on mute.
Yes, I am. So how has Northern sort of modified our investment strategy in line with the 5-year with the outlooks that you guys presented?
Yep. Yeah. So Wouter presented our long-term strategic outlook, which is basically our 5-year outlook for different asset classes. Every year we roll in these new capital markets assumptions that we get in late summer, early fall into our analysis for kind of looking at what kind of long-term strategic targets we have for the portfolio. We do have long-term targets set up, and I think a prior page had those, so maybe I'll just reference those quickly. So in the investment policy statement, we do have targets. So equities are at 44% target, fixed income at 29%, and alternatives as a broad asset class are 25%. So every year when we get these new capital markets assumptions, we will look at our long-term targets given where we are with risk and return options in the portfolio. We got a little bit higher capital market assumptions this year than we had in the prior year. So as we rolled that into our outlook for the portfolio, on the margin, we didn't make any changes in the long-term investment policy statement, but it's an annual process for us. So we incorporate our annual capital market assumptions into our outlook.
Okay, and then a couple more here. What percentage of our assets are invested outside of the U.S.? So I know we have a few PE funds that are out as well. So.
Yep, yeah, it's a very good question. It's easier to disentangle that when you look at it from an equity-only perspective. So we do have currently 13.3% of the portfolio in developed markets ex-US. That's primarily Europe and Japan. And then the emerging markets perspective, about 3.8%. So again, versus the targets that we have set up strategically, we're a little bit underweight emerging markets and about in line with our developed ex-US exposures.
Okay, and then one more here. How does Northern sort of balance your guys' investment allocations with any sort of ESG strategy or ESG rating outline?
Yep, very good question. It's very topical, and we've been talking to a lot of clients about sustainable investing and ESG. We're not currently incorporating any ESG metrics in the management of the portfolio. It's something we track internally. So if anyone does have specific questions about any kind of sustainable investing or ESG metrics around the pool that we manage, I'm happy to answer those. So I would encourage, if anybody does have questions, to kind of forward those on and we can get back to you.
Yep. Okay, it looks like that's it for questions. Thank you, Marty, for taking the time to join us this morning. And thank you to everyone on the call. We appreciate any and all feedback. So please let us know what we could do better, what you guys liked, what you guys didn't. Thank you, everyone.
Yep. Thanks, everyone. We'll see you next time.